Hello and welcome to BQ Prime's earnings conversation with VGuard. I have with me Sudarshan Kasturi, Senior Vice President and CFO, Finance and Accounts Department, to walk us through the June quarter performance and also the outlook for the quarters ahead. Thank you so much, Mr. Kasturi, for taking the time.
Yeah, my pleasure. Thank you.
The Q1 numbers look good and largely in line with estimates. Revenue up 19.3%, net profit increased about 20% at 64 crore. EBITDA is up 27.7%, while margins expanded to 8.6% versus 8.1% a year ago. So, Mr. Kasturi, I would like to begin by asking you, how is the overall demand scenario? What we know from the post-earnings media statement is that the demand in the North region was somewhat impacted by unfavorable weather conditions. But how has been the other segments? Regions performing?
Yeah. Overall, it's been a good quarter for us. The top line growth came in strong, as you mentioned, 19% growth. And this growth is broad-based. All our segments have done well. Among the segments, electronics grew the fastest, but the other two, electricals and durables, also delivered double-digit growth. We did mention that North performance was a bit muted because of inclement weather. So that impacted numbers in the North region to some extent. But the other regions, the other three regions have delivered strong growth.
Right. So category-wise, just to have a recap of the numbers. So electronics grew about 20%, and electricals recorded a growth of about 10%, while consumer durables grew 10.7%. However, the consumer durable segment has recorded an EBIT margin of 0.3%, which is down 100 BPS. So what is ailing growth there, and what is your outlook on this particular sector?
Yeah. Consumer durables for us today is becoming a successful business. In the last 5 years, those categories put together have delivered about a 20% CAGR. So in terms of size, durables is nearly catching up with our traditional electronics business. So on its way to becoming a very meaningful category. But that's also the most impacted in terms of margins with the commodity cost increases that we have seen in the last year or two. While we have seen margins recover somewhat sequentially over the last 2 quarters, there is still some more recovery to happen. So the durables margins are a bit suppressed because of input costs, but they are improving.
But what about demand? Are we seeing demand, or is it a price-led growth that we are seeing in the consumer durable segment?
We've seen good growth. It's pretty much demand-led.
Okay.
We've seen demand, although there were some concerns at the beginning of the year, a bit of a slow start, but we've seen numbers come back quite strongly towards the second half of May and June. And our focus growth categories have done quite well.
Okay.
Margin improvement is still work in progress, and yes, we have some way to go. Yeah.
Got it. So what is the kind of range that you are targeting for the consumer durable? Like, what is the sustainable range for the consumer durable segment?
Pre-COVID, we used to make about 5 to 6% EBIT margin in durables. Okay. And bear in mind that 5 to 6% is after corporate allocations. So, I mean, really speaking, even the 0.3 today is actually, maybe a 4 or a 5% contribution if we ignore allocations. Okay? But yes, there is a task to get back to what the pre-COVID margins were. And, we hopefully will, resolve it in a couple of quarters or so. Yeah.
Got it. Right, sir. Also, in terms of your overall margins, we are seeing improvement, and we did see an improvement over the last year, even in Q1, backed by easing input costs.
Right.
But given that the ad spends are also reviving, so what are your targets for FY24?
Our first target is to get back to our pre-COVID EBIT margins. Fundamentally, we are at least a double-digit EBIT margin business.
Yes.
So we need to get back to that range. We're still around the 8.5. We have seen better days before all this inflation effect came in, where we have delivered 10% plus.
Right. But we
That
are also expected to see your ad spends going up, right?
ad spends are nearly back to their normal levels now.
Okay.
Our current ad spends are around the 2.5% mark, which is which is normative for this, for this business.
Okay, but generally, as we enter the third quarter, which is like the festive season, so ad spends goes up. So in
Of
that sense,
course.
I want to know, like, what is the kind of
Yeah,
percentage
of
of this
course.
to sales?
Of course, ads are targeted around specific categories at specific times of the year. Okay.
Mhm.
There is always the allocation of the ATL money is different for markets and products and so on.
Yes.
And you're right, we should be seeing higher spends in the coming months because of festive season. Absolutely. Yes.
Got it. Mr. Kasturi, I would also like to know that your Sunflame business has posted revenues about 63 crore in Q1. So how do you view the performance of the Sunflame business? And also, has it managed to actually meet your internal targets?
Well, it is a period of transition for Sunflame. We are still new. So far, what we have been able to do is to have a management team in place. We have done the senior hiring and created the basic alignment
Mhm.
there. But there is always a transition period before we can get our arms around and start driving growth. Okay. So therefore, we have prioritized a few actions. One is to get Sunflame into South, which
Okay.
is a low-hanging fruit, right? Given that we are strong in South, that's the most obvious thing to do. The other thing is Sunflame is underrepresented in e-com where we have a significant play. So, that's the
Yes.
other immediate opportunity, right?
Okay.
So we'll start with these first. Okay.
Okay.
There are many more growth avenues and areas of synergy that are possible, but we have not started working on them yet.
Yes, but if I remember it correctly, you had put a 400 crore target in the next 2-3 years. You had mentioned for Sunflame. So are you
Right.
on track?
Yes, we will get there. I mean, these are those depend on our integration plans getting implemented and so on. So we're getting started on that.
Okay. Okay. So when can we expect that 400 crore turnover to actually hit? Can we expect is it right to assume in another 2-3 years?
I would suggest you wait for the results announcement.
All right, sir. Okay, got it. And also, in terms of the synergy benefits, are you seeing some kind of benefits already flowing in?
Very initial stages yet, so
Okay.
I wouldn't say we have started to get synergy benefits, but we know we have some plans on what we can do on the cost side or what we can do on the capacity utilizations and aligning the sales systems and things like that. So we will have a growth strategy plan put in place and then we implement. At the moment, we've only created basic alignment. Get MIS, get controls in place. Get a CFO in place. So those are the things we have
Okay,
done
so
so far.
yes, got it. Coming to your South and non-South mix. So in
Mhm.
Q1, what we have seen that your non-South business has grown about 17%, which is at a much faster pace than your South business at about 10%. So,
Right.
what is the kind of revenue contribution we can expect to see from the non-South and South going forward?
Yes. So if you look at, maybe go back 10 years, we were predominantly a South India company, a South-based company. And, we ventured into non-South markets about 10 years ago. And it's been the case that from near zero, we have built a business which is nearly half of our turnover today. So, truly a pan-India company now. It's no longer a regional player. And this has happened because over the last 8 years, 10 years, non-South has grown faster than South. Okay.
Yes.
Right. And even now, I would think for the next 3-4 years, there is still more scope to
Okay.
to get a larger portion of the business in non-South.
Okay.
If we see the distribution of population and the market sizes, Perhaps north is 60, non-south is 60, and south is 40. Okay. But we are like maybe 50-50. Okay. So if we have to get to maybe 55%, that would probably, take another 2-3 years, I guess.
Okay. So coming to the consumer durable segment, I have one question there. I forgot to ask you. So basically, I wanted to know in terms of the inventory levels, like have they kind of, have you been able to clear all the high priced inventories, or are you still seeing an effect of that on the business?
Yes, we are past that. We went through a period where inventory holding was high, and it was also at a higher cost, right?
Got it.
But we've been able to reduce inventories back to their normal levels now, and so that issue is behind us.
Got it. And in terms of your online channel, so how much does online contribute to your overall business?
For the relevant categories, it's about 8 to 10%.
Okay, and do you expect that kind of growth to sustain going forward, or do you think that it has come to it has stagnated?
No, e-commerce is still growing faster than the average business, definitely.
Okay.
Right. Both e-commerce and modern trade, which is the organized trade, we call it. Those channels are growing faster. So we should expect e-commerce to become bigger.
Okay, and any numbers you would like to put? Like, what is the kind of contribution you expect from the e-commerce channel, maybe for FY24 or the medium-term target?
Well, not the medium term, but I would say destination. If you look at the nature of product categories and the way the market is growing, I think at the end point, e-commerce should be giving 20% of those category businesses.
Okay. So 20%.
I don't know how many years it will take to get there. It depends on how fast that segment grows. Difficult to guess because in the COVID era, e-commerce grew very fast. Okay.
That's right.
And then post-COVID growth has sort of moderated.
Yes.
But it's still growing fast. Yeah.
It's still growing faster. All right. Okay. Thank you, Mr. Kasturi. It was a pleasure talking to you.
Okay. Thank you very much.